Hello everyone, it's Marshall Gittler of ACLS Global, bringing you another lesson in the ACLS Global FX Trading School. In our last video, I described the various trading sessions. Now, I'd like to discuss how currencies are quoted. Abbreviations for currencies. Each currency has a three-letter abbreviation. The abbreviations of the most commonly traded currencies are as follows. The US dollar is USD. The euro is EUR. The Japanese yen is JPY. The Great British Pound is GBP. And the Swiss franc is CHF. As you may notice, the first two letters are usually the official two-letter abbreviation for the country. US, JP, GB, etc. While the third letter usually refers to the name of the currency, the dollar, the yen, the pound. For the Swiss franc, CH stands for Confederatio Helvetica, the official name of the country. The euro is an exception since it's the currency of several countries. Just for your information, the abbreviations for currencies are determined by the International Organization for Standardization, the ISO, in standard number ISO 4217. Nicknames of currencies. Some currencies have nicknames that are widely used in the market. The sterling dollar, the pound against the US dollar, is commonly called cable. From the days when the rate was transmitted by underseas cable every day from New York to London. People would ask, "What's the cable today?" And the name stuck. Canadian dollar is often referred to as the loonie, from the common loon, the bird that appears on the country's $1 coin. The New Zealand dollar is known as the kiwi, after that country's iconic bird. And the US dollar is known as the greenback, for obvious reasons. The most frequently traded currencies are those of the major industrial countries: the US dollar, the euro, the Japanese yen, sterling, the Swiss franc, Canadian dollar, New Zealand dollar, and Australian dollar. These are called the major currencies, or the majors. They generally have the narrowest spreads and the most activity. Most other currencies you'll encounter are referred to as minor currencies. Some emerging market currencies, though, are referred to as exotics. How currency prices are quoted. When you see currencies quoted on your screen, you'll always see two prices, the bid and the ask. In finance, the bid price is the price to buy something at, while the ask or offer price is the selling price. Think of it as bidding on something at an auction. This is the price the person is willing to pay, or offering to sell something, or how much are you asking for your house. Now, it's important to note that this terminology is from the market maker's point of view. The bid is the price at which the market maker, in this case your broker, is willing to buy, while the offer is the price at which the market maker is willing to sell. The distinction is really important because it's the opposite from your point of view. That is, you, the client, sell at the bid and buy at the offer. As we say in the market, you hit the bid or you pay the offer. The market convention is to put the bid on the left-hand side and the offer on the right. Well, that's from my point of view. The bid is always lower than the offer because that's how market makers make their money, through the spread between the bid and the offer. It's easier to think of it in terms of stocks rather than currencies. So, for example, if a stock is trading at $100 to $101, it means a market maker is bidding for the stock, will buy your shares for you for $100 a share, while the market maker is offering to sell you the stock at $101 a share, or asking $101 for one share. So if the bid for that price stock is $100, that's the price you can sell at. If the offer is $101, that's the price you can buy at. It's a little more confusing in the FX market because in FX, as I've pointed out before, you're simultaneously buying one currency and selling another, rather than using a currency to buy something else. So a bid for currency A is automatically an offer for currency B. Base currency and quote currency. The currency pair is made up of a base currency and a quote currency. The base currency is usually, but not always, the larger of the two units. Normally, it's the US dollar, except in the case of the euro and those currencies associated with Britain and the Commonwealth, the pound and the Australian and New Zealand dollars. The Canadian dollar used to be quoted that way as well, but the market convention changed. Currency pairs that don't involve the dollar, such as Aussie dollar versus New Zealand dollar, are usually called cross rates. When writing the name of the currency pair, the base currency is on the left-hand side and the quote currency is on the right-hand side, such as dollar yen or euro dollar. The pair name represents how much of the quote currency, the one on the right, you have to sell to buy 1 unit of the base currency, the one on the left. For example, if dollar yen is trading at 110, then you have to pay 110 yen to get $1. If euro dollar is at 1.10, then you have to pay $1.10 to get 1 euro. In short, you buy or sell the base currency using the quote currency for payment. Your trade is denominated in the quote currency, or quoted in the quote currency. Just like you might say that 1 kilogram of rice costs a certain amount of euros, you would say that 1 euro costs a certain amount of dollars, $1 costs a certain amount of yen. The base currency is the rice, and the quote currency is what you use to pay for it. Now, this way of quoting currencies can seem counterintuitive because the slash mark between the two names seems to signify division, as in dollars per yen or euros per dollar. In that case, one would have to quote dollar or yen dollar or dollar euro. In fact, some academics do refer to currency pairs in this fashion, but it isn't the market convention. To avoid this confusion, some authors use a dash instead of a slash mark, and some use nothing in between the names. Bid and offer in terms of base currency and quote currency. We discussed bid and asking prices earlier. To put it in terms we now know, the bid is the price at which a market maker is bidding to buy 1 unit of the base currency. The price is quoted in terms of the quote currency, which is why it's called the quote currency. The offer is the price at which the market maker offers to sell 1 unit of the base currency. Again, in terms of the quote currency. From the client's point of view, of course, it's the opposite. The bid is how many units of the quote currency you will get in return for selling 1 unit of the base currency. While the offer is the number of units of the quote currency you'll have to pay in order to buy 1 unit of the base currency. Spreads. The spread is the difference between the bid price, the price the market maker will buy at, and the ask or offer price, the price the market maker is selling at. The spread is a measure of the profit margin of brokers. Spreads are narrower in more commonly traded pairs, such as euro-dollar, than in less widely traded pairs, such as emerging market currencies. Spreads can change. They tend to widen when markets are volatile and narrow when markets are calm. That's because there's more of a risk the market maker could lose money on the trade when markets are volatile, and so the broker needs to be compensated for taking on that increased risk. Moreover, some currency pairs, such as Australian dollar against New Zealand dollar, Aussie Kiwi, will have narrower spreads during the Asian day, while others, such as dollar Canada, will have narrower spreads during the US day. This reflects increased activity and therefore increased liquidity in the pair. The spread between the two prices is how the market maker makes money. As in any market, the trader buys low and sells high and makes money that way. How professionals talk about a trade. Many people talk about buying euros or selling yen. It's usually assumed that the dollar is the other currency they're buying or selling against. But this isn't always the way the professionals in the market talk. I learned that shortly after I switched from being a bond analyst to being an FX strategist. I mentioned something to a salesman about buying yen. He took me aside and said, "Marshall, we like clients who say buying yen." The implication was that these weren't particularly sophisticated clients. Professionals in the currency market usually talk in terms of buying or selling a currency pair, not just the quote currency. For the two examples above, a professional would talk about buying or selling euro-dollar and buying or selling dollar-yen. This might be abbreviated to buying or selling the base currency, but not the quote currency. So for example, while professionals might talk about buying euros when they're buying euro-dollar, they don't talk about buying yen or selling yen. They talk about selling dollar-yen or buying dollar-yen, respectively. Summary. So in this video, we covered how people in the market quote currencies. Each currency has a 3-letter abbreviation. Currency trades are always quoted in pairs, with the name of the base currency, usually the larger of the two, coming first, and the quote currency coming second. The pair is quoted in terms of how many units of the quote currency it takes to buy 1 unit of the base currency. Professionals usually talk in terms of buying and selling the currency pair, not just the quote currency. When you see a currency pair quoted, usually there are 2 prices given, a rate to buy the base currency and a rate to sell the base currency. The difference between the two, the spread, is how the market maker makes a living. This is Marshall Gittler of ACLS Global with another educational video. Trade FX with knowledge.